We have a new IPO in the works, Utkarsh Small Finance Bank. IPO to open on the 12th of July, close on the 14th of July. The price band for the stock is 23 to 25 rupees per share. 600 shares a lot will be allocated to you as a shareholder if you do subscribe to the IPO. The listing date is the 24th of July. Now that all of that is taken out of the way, let's try and break down as to what this bank is all about. And firstly, with regard to the capital itself. Now, you're looking at a capital raise of around 500 crores, so around 20 odd crore shares to be issued by Utkarsh in this IPO. Pretty much all of it is a fresh issue of shares. Of course, the net proceeds, as is the case in the banking sector at the moment, is going to largely be used for the purpose of shoring up your capital and to shore up your capital adequacy as well, to enable lending, because currently you're in the midst of a cycle. So even though the capital adequacy is above 20% consistently over the last 3 years, they are still looking to issue shares largely to try and get growth up to speed. Quickly talking about the company itself, the company is largely focused on the rural segment. It was incorporated in 2016, focused largely in rural and semi-urban areas, as well as largely doing MFI. Around 2/3 of its book currently is MFI, which is microfinance lending. Also, in terms of geographic presence, quite a large presence. 26 states and union territories is what it's present in. But even within geographies, it has a concentration to Bihar and UP. So around 50% plus of its lending happens there currently. Of course, it's trying to diversify and diversify fast, but of course, some of those things take time. 830 banking outlets is what it has. It has 15,000 plus employees. Around 36 lakh customers is what it has, so a large customer base. And around 27.5% of its banking outlets of 830 banks or 830 outlets are currently in unbanked rural centers. So that gives the bank a sort of a presence where no other bank is present. So it is probably running a monopoly in around a fourth, which is 27 odd percent of its 830 outlets. In terms of its products, we did speak about micro loans. So micro loans, which also comprises of joint loans that it gives, joint group loans, it gives two-wheeler loans, individual loans, all of those comprise around 2/3 of the loan book. You're also looking at retail, which is around 11% of the loan book. Wholesale is around 11% as well. And then you have housing and others, which comprise around 12% of the loan book. That's the broad breakup of the loan book. Of course, it's diversifying into some of these other areas as well. But currently, you're seeing that it's concentrated in the microfinance sector, which is, of course, risky lending. But nonetheless, in terms of financial performance, it's done quite well. In terms of the way the loan book has shaped up, it's gone from 8,400 crore, of loan book to around 14,000 crore at the end of FY23. So growing at a very healthy clip there. You can see more than 60% in terms of its growth number, almost 60% in terms of its growth over 2 years, of course. You're also seeing deposit growth move very, very well. So loan growth is at 8,400 in FY21. It's gone to 14,000 crore, but deposits was at 7,500 and it's gone all the way up to 13,700 crore. So clearly you can see the gap between loans and deposits has come down and has shrunk. So your CD ratio, as they call it, has come down quite sharply. Also, very quickly moving on, your net interest income, which is typically your top line for the bank, has nearly doubled. 830 crore was that number in FY21. It's come in at 1,530 crore in FY23. You're also seeing net interest margins expand. Now, this happens for two reasons. One is that the bank is lending at higher rates, or the bank is borrowing at lower rates. Now, the latter as well as the former, both are playing out. So the net interest margins, which is the difference between what the bank receives versus what the bank pays out in terms of interest, has actually gone up quite significantly and quite sharply, despite the loan book not really doubling up. Also, Therefore, the profit after tax has gone up even more sharply. So from 112 crore, profit after tax has gone up to 400 crore. Therefore, ROAs have expanded very, very sharply from 1% to 2.2%, which is probably best in class ROAs. In FY23 is what this bank has clocked, best in class across the industry. So pretty much hitting it out of the park. But of course, it's a small bank and it lends to an extremely niche sector, a very tough segment to lend to and a very risky segment to lend to. And when you are lending to riskier segments, your yields, which is your loan rates, are often high, and therefore your profitability is often higher. And that's exactly what's playing out. So don't take this at absolutely the face value, but of course, it's a very healthy growth in terms of ROAs nonetheless. Your yields have steadily moved higher from 15.5% to 15.7%, but your cost of funds, which I spoke about, the difference between what you take in terms of deposits and the cost of deposits, therefore, has fallen roughly from 8.5% to 7%. And that's really translating on your net interest income and your net interest margin, which is your top line of the bank. Let's also look at CASA. CASA showed up quite well. 21% is where the CASA is currently at. Your cost of your operating expenses to income, it's a ratio. The operating expenses to income, that ratio is doing quite well. It's actually falling because you're scaling up, and as operational efficiencies kick in, that ratio typically falls. Your GNPAs are at 3.2%, but your net NPAs are at 0.4%. So largely provided for, well provided for is what this bank currently is at. It's well provisioned, right? We did speak about capital adequacy, and your CASA ratio though is slightly poor. It's at roughly 20 odd percent. So your CASA ratio needs to improve a little bit, but as the bank scales and as it gains more ground, that CASA ratio ought to improve. In terms of what is the strategy as well as what is the strength of this bank, what they suggest is that they have a large rural presence, so they are continuing that particular piece, which is doing quite well. They're going to focus going forward on retail deposits and to build a stable funding source. So they believe that growth on the lending side is coming, but on the funding side is not coming, and you can see that the deposits number has gone up quite sharply. So as that plays out, you will see that they are more focused on the retail, on the deposit side, to show on more deposits so that they can lend better. They also suggest that they have significant cross-sell opportunities. 36 lakh customers is what they have, which has grown quite significantly and grown quite well. 25% growth in terms of number of, 30+% growth in terms of number of customers over the last couple of years. So you're seeing that that particular metric means that you can cross-sell more products to different customers, and that's what they are suggesting could be a possible, could aid top-line growth in the future. So that's a positive. And they're trying to play the cost efficiency game going forward as they grow. They're a small finance bank. As they grow larger, cost efficiencies will start to play out. Currently, its promoter 84%, 85% in fact, is held by Utkarsh Core Invest, which is the sole promoter, and Utkarsh Core Invest itself is held by British International Investment PLC. 14% of it is held by British International. Also, then you have RBL Bank holding 10%, Shriram Life holding 5%, Sidbi holding 5%. You have the likes of an ICICI Pru and an HDFC Life holding 4% and 3% respectively in the holding company of this bank. Largely post the issue, the promoter shareholding will fall to 69% and the public shareholding will expand from 15% to 31%. That's how the story is currently framed at. Of course, at 23 bucks to 25 bucks a share, it's trading at 1 to 1.2 times price to book. Price to book is the metric which we take for purpose of valuing banks. Most small finance banks are currently trading at a price to book in excess of 2. So this looks like a very solid discount in terms of its price to book, or its pricing, or its valuation metric, as one would call it. So it's being priced at that particular price point, obviously because it's a risky proposition to lend to MFI, and typically your provisions are very, very high. It's a cyclical business where if the microfinance institutions across a particular geography fail, you will have large and chunky provisions which will hit and which will create large losses on your balance sheet. And that's how currently this particular pricing methodology has been arrived at, giving room for all of these moving parts, of course. But it looks like Utkarsh Small Finance Bank all set to IPO. Of course, we have to wait and watch for what kind of interest we are going to see in this one.
If you like this video, then like, share and subscribe to ET Now.